Are you struggling to pass the CPA exam? Did your review course fail to fit your learning style? I'm Darius Clark of I-75 CPA Review, the #1 course supplement, where the right teacher makes all the difference. Which of the following procedures would assist the auditor in determining that accounts receivable is properly presented on the balance sheet at its net realizable value? 1. The auditor tests the aging of the accounts receivable trial balance. Yes, because what assertion is the auditor looking for here in this question? They're looking for valuation of receivables. How do we know? Because it's asking for accounts receivable properly presented on the balance sheet at its net realizable value, not the gross amount, the net amount. And that means valuation assertion is the assertion in question. And whenever the auditor is interested in valuation, the auditor will test the contra asset. So #1 says the auditor tests the aging of accounts receivable trial balance. Sure, because the aging schedule, the ending balance of the aging schedule, becomes the allowance for doubtful accounts balance. So remember, anytime the auditor is looking for valuation assertion, the auditor will test the contra asset. So 1's good. How about 2? Auditor selects shipping documents and traces them to the related sales invoices and entries in the sales journal and accounts receivable subsidiary ledger. So now you're doing more of a two-directional test. You're starting with the shipping documents. You're looking to see if goods were shipped, when were they recorded as sales? Now you're probably interested in things like overstatement in the current audit period. Because if goods were shipped out in January, they shouldn't have been recorded as sales in December. And if they were, then you got improper cutoff. You've got overstatement of sales. And now we're talking about the gross figure of accounts receivable, not the net amount. So with valuation, which is what they're asking about in the question, you're interested in the net amount of accounts receivable, the amount after the contra asset. But in #2, they're pointing to the gross amount of the sale, possibly being overstated because of improper cutoff. Prager CPA is performing an audit of Belfer Corp., an issuer for year 18. Which of the following items below would Prager CPA likely conclude requires neither an adjusting journal entry at December 31st, year 18, nor disclosure in the footnotes for Belfer Corp.? How about A? At the end of year 18, a major customer owing a significant accounts receivable balance filed for bankruptcy. The normal estimate of uncollectibles was not intended to address accounts of this magnitude. So that's going to require a journal entry, and since it happened at the end of year 18, not even in the subsequent period, but still at the end of 18, you would just make an adjustment. B, the issuance of a negative report by an analyst that resulted in a 30% drop in Belfer Corp's share price. Well, the issuance of a negative report or a positive report by an analyst, that does not result in an adjustment nor any disclosure at year end. How about C? Interest has been paid for 11 out of 12 months on a line of credit with the client bank. Well, why not 12 out of 12 months? Interest has to be paid every month. So if only 11 out of 12 months were paid, then 1 month is still owed at year end, probably December, and that would require a debit to interest expense and a credit to interest payable. D, a lawsuit was filed during the year and the client counsel feels that the client has a possible chance to lose $5 million, an amount considered material. So possible, not probable, means we don't need a journal entry at year end, but possible chance, and it's considered material and we've estimated it to be $5 million, we're certainly going to need to disclose it as a footnote. Remember, the facts are pointing to which of the following would likely require neither an adjusting entry nor disclosure. The only one here would be letter B. In an audit of financial statements, the risk that the auditor's procedures performed to reduce audit risk to an acceptably low level will not detect a misstatement that exists and that could be material, either individually or when combined with other misstatements, is known as, and that's detection risk. Detection risk is all about the auditor performing the auditor's procedures. Remember, once the risk of material misstatement has been assessed, because you've assessed inherent risk and control risk, now it's up to the auditor to either lower detection risk or not lower it, possibly raise detection risk, and that means performing audit procedures to gather specific evidence. And in performing those procedures, the auditor could screw up a procedure. Maybe they chose the right procedure, but they did it wrong, and if they would have done the procedure correctly, they would have found the material misstatement that was there. For example, maybe the auditor was searching for an overstatement of sales. So if that's the audit objective, to search for a possible overstatement of sales, the test should be to start with entries in the sales journal, see what was recorded in the books as sales, and then move to the event that's uncertain. Were the goods ever shipped? Look for shipping documents. That would be a good test for overstatement. Start with what was recorded in the books and look for evidence that it really should have been recorded. But what if the auditor chose that test but performed it backwards? Started with the shipping documents and looked to see what was recorded as a sale. Well, that would test for understatement, but it wouldn't test for overstatement. So if the audit objective was to test for overstatement and they screwed up the test because they performed it backwards, that would be a detection risk issue. That's the risk that the auditor's procedures performed to reduce audit risk to an acceptably low level will not detect a misstatement that exists. There's a risk that the auditor is going to screw up their own procedure. Control risk is the risk that a misstatement will not be prevented or detected and corrected by the entity's internal controls. And the risk of material misstatement, that's the risk that the financial statements are materially misstated before the audit, before taking into account the audit procedures that are going to be performed. According to SAS 134, circumstances in which an auditor must include an emphasis of matter paragraph include which of the following? Audits of financial statements prepared in accordance with special purpose frameworks? Yes, there are certain auditing standards that require an auditor to include an emphasis of matter paragraph, and that list includes audits of financial statements prepared in accordance with special purpose frameworks. So if the financial statements were presented but not in accordance with GAAP but in accordance with some other framework, guess what? You're going to need an emphasis of matter paragraph. How about for accounting changes that result in a lack of consistency? Yes, because consistency of reporting is implied in the audit report. That means the auditor doesn't express consistency unless there's a problem, unless there's a lack of consistency, and that's what you have here, where you have accounting changes. It's implied in an auditor's report that the accounting principles used are applied consistently from period to period. And when that doesn't happen because you have accounting changes, then you have to mention it in the report. And that will be done by using an emphasis of matter paragraph. So the answer is both of these would require an emphasis of matter paragraph. Remember, an emphasis of matter paragraph is for something that is already mentioned somewhere in the financial statements by the client, either in the footnotes or maybe in one of the statements, and the auditor is calling attention to it.